January 2026. Silver is sitting just under $80 an ounce after one of the wildest rallies modern markets have ever seen. In the same year, the dollar that your salary and savings live in has just had its worst performance since 2017. While those numbers are flashing on trading screens, China still holds more than $3.3 trillion in foreign reserves, quietly swapping those paper claims for mines, refineries, and the raw materials the modern world cannot function without. That is the part almost no one is watching. Wealth and power are seeping out of currencies and into physical things, out of promises that can be created in an instant, and into resources that take decades to find, dig up, and control. If that continues, it does not just move lines on a chart. It decides what your pension is actually worth, how far your savings really go, and who ends up owning the assets everyone else has to rent for the next 50 years. Over the next 20 minutes, we will look at how that shift is unfolding, why China is pushing so hard into real resources, and how it could quietly rewrite the value of every dollar you own over the coming decade, so you can see which side of that transfer you are standing on. By the time most people realize where the wealth has gone, it will already be sitting in someone else's hands. To understand what that shift is really about, think about what actually keeps your life running for a moment. Not the number on your bank app, not the lines on a market chart, but physical things. Copper wires that carry electricity, silicon chips full of strange metals, magnets inside engines, and turbines made from rare earth elements most people have never heard of. Underneath all that noise, there are three basic levers of economic power. First, there is currency, the unit everyone uses to quote prices and settle trade. Second, there is credit, the system that decides who borrows cheaply and who pays a painful rate. Third, there are commodities, the raw materials without which nothing gets built at all. For most of the last 70 years, the West sat on top of the first two. The dollar was the reference point for global trade, and Wall Street, together with European banks, controlled the main channels of credit. China has chosen to focus on the third lever. For a long time, the story sounded simple. China made inexpensive goods, the West sent demand and money, and as long as shelves were full and prices were calm, nobody asked too many questions. That phase is ending. China is no longer satisfied with being a workshop that assembles other people's designs. Beijing is working, step by step, to become the choke point. Instead of just shipping finished products in exchange for foreign cash, it has spent years building control over the supply chains. For the metals and minerals every advanced economy depends on. Rare earths for powerful magnets and guidance systems. Platinum group metals for catalysts and specialist chemicals. Copper for power grids and data centers. Lithium, cobalt, nickel, and manganese for batteries. Gallium, germanium, and indium for semiconductors and screens. In sector after sector, Chinese companies have moved to dominate either the mine, the refinery, or both. In rare earths, for instance, they control most of the processing capacity, even when the ore comes out of the ground in someone else's country. If you control the critical materials, you do not just take part in the future economy, you can squeeze it. You decide who is allowed to build what and at what cost. You decide whose factories keep running and whose projects sit on hold. On the ground, this looks very concrete. In the Democratic Republic of Congo, one of the most important regions for copper and cobalt, a giant mine called Tenke Fungurume changed hands. A major United States company sold its controlling stake for billions of dollars to a Chinese miner backed by Chinese banks. That one deal moved a huge stream of future battery metal production from Western balance sheets to companies aligned with Beijing. Across West Africa and South America, Chinese firms show up at auctions for gold, copper, and lithium projects with cheaper funding and richer offers than Western rivals can afford. Deal after deal quietly shifts the path of tomorrow's metal exports. When political tensions rise, Beijing is also willing to use its strength in processing as a lever. Export controls on obscure-sounding materials, such as gallium and germanium, have already forced chip makers and defense contractors in the United States, Europe, and Japan to scramble for new suppliers, pay more, or delay work. Now put that alongside another fact that rarely makes headlines. China has built up a vast pool of foreign currency reserves and claims on overseas government debt. For years, that was taken as proof that the system anchored in the dollar was unshakable. People said that Beijing had no choice, that it had to hold those assets, that this showed the dollar was beyond question. But there is another way to look at it. If you are sitting on a pile of financial claims, just as the country that issues that currency is running very large deficits, cutting rates, and arguing in public about how independent its central bank really is, do you want all of your long-term wealth tied to that promise? Or do you start, slowly and deliberately, to swap more of that paper for the kind of assets other people will still need in 10, 20, or 30 years' time? Whatever happens to the currency that paid for them, To really see how this works in practice, take one metal as a case study, silver. For a long time, people thought of silver as poor man's gold, mainly a store of value with a bit of industry on the side, but the picture no longer fits. In the last few years, it has turned into something much closer to a strategic ingredient. It is built into advanced electronics and modern chips. It is crucial for solar panels, and it appears in military hardware, aircraft, medical equipment, and the wiring that feeds an electrified grid. At the same time, mine output has struggled to keep up. We are now at the point where traders are not only arguing about what silver should cost, they are starting to worry about whether enough metal is available at all. In 2025, the price did something remarkable. It did not simply edge higher, it jumped. From roughly the low 30s, it drove to new records, more than doubling in a year and pushing toward the high 70s per ounce. That alone would have been a big story. What happened inside China made it much more than that. Chinese savers and investment funds began to look very closely at how the silver market is built. They saw something many Western investors tend to overlook, that in the financial market there can be layers of contracts and derivatives resting on a much smaller pile of metal in storage. Picture a single bar sitting in a vault. Then picture a tall stack of digital tickets, each one giving someone a claim on that same bar. The structure works as long as only a few people ask for delivery at once. If you are worried about scarcity, that setup suddenly feels fragile. In that situation, you do not want a promise. You want the bar itself, coins in a box, stock that can be moved. That is where Chinese demand went. Buying of physical silver inside the country surged. Local funds that specialize in the metal pulled in huge amounts of money. One product became so popular that its market price climbed to roughly 60% above the value of the silver it tracked. A gap so extreme that regulators stepped in to cap new inflows so latecomers would not be wiped out if the premium disappeared. At the same time, the price paid for real metal in China moved clearly above international benchmarks. Instead of matching the quotes in London or in New York, local buyers were paying an extra margin, sometimes in the low double-digit range. In theory, that gap should close quickly. Traders would buy metal where it is cheaper, move it, and sell it into the richer market, locking in profit until the prices line up. The fact that the difference has persisted tells you that supply is tight, and moving metal in bulk is not as simple as the textbook version. There is plenty of speculation in this picture. Paying a 60% premium for any asset is risky, and people who chase those premiums can lose a lot even if the underlying metal barely moves. Underneath that speculative layer, though, the signal is clear. Chinese households and institutions are using their money to make a statement. They are effectively saying that they would rather hold something solid in a vault than a digital claim on it, and that they expect the world to find itself short of this metal in the years ahead. Silver is simply the clearest place where that attitude shows up. Now imagine the same logic we have just seen with silver applied across a whole range of critical materials. That is what Beijing has been doing. Chinese companies and state funds have poured tens of billions of dollars into mines for copper, lithium, nickel, and cobalt in Africa, Latin America, and beyond. China has tightened export controls on key processing technology and on rare earths, which has strengthened its position in refining and magnet production. In some negotiations, Chinese buyers step in when Western firms need to sell and use cheap state-backed finance to take over assets that will supply electric vehicles, power grids, and electronics plants for decades. In others, they simply offer more money and throw in roads, ports, or power lines. If you're a cash-strapped government with valuable geology and one bidder offers a low market price, while the other offers a higher check and new infrastructure, you can guess which offer is hard to refuse. All of this is happening while China still reports foreign currency reserves well above $3.3 trillion and quietly adds gold to its central bank holdings month after month. On the surface, it still appears to hold a huge pile of dollar assets. In reality, it is slowly changing what those assets represent, shifting away from financial promises toward control over physical supply. That is the key idea. Every ton of copper, every kilogram of nickel, every ounce of silver or gold that China acquires is one more slice of dollar exposure turned into something you can actually use in a factory. It is a quiet transfer of wealth out of things that can be created with a keyboard and into things that take time, energy, and equipment to extract. We have seen echoes of this pattern before. In the early 20th century, Britain moved from issuing the world's main reserve currency to presiding over a drained empire. The pound slipped as the country struggled with debt and shrinking influence, while the United States, with its industrial base, its oil and its gold, moved into the role of financial center. In the 1970s, when inflation and the end of the gold standard shook faith in the dollar, Washington responded by building the petrodollar system, trading security guarantees and political backing for one crucial condition, that oil exports would be priced and settled in dollars. Then, the rising power built its influence around its currency. Today, China is trying to build influence around something much harder to dilute, the materials themselves. Now set that against what is happening on the other side of the balance sheet, in the United States and in the wider currency market. The dollar has just lived through a painful year. A mix of tariffs, public fights over Federal Reserve policy, and rising concern about large budget deficits has pushed broad dollar indices lower. Over the same period, hard assets have moved the other way. Gold has logged one of its strongest years in recent memory, and silver, as we have already seen, has been even more explosive. Traders who specialize in currencies and options are not treating this as a random blip. Market positioning and surveys point to a clearly bearish mood on the dollar, with many professionals expecting a weaker phase that could last for years, much as we have seen in previous long cycles. So you have a reserve currency that is losing altitude. You have a rival power steadily converting its savings out of that currency and into raw materials. You have a metals market flashing warnings about tight supply and violent price swings. That on its own would be enough to keep serious investors up at night. But there is another shock building that most ordinary savers are not watching, and it is coming from Japan. Japan has quietly been one of the supports under the dollar system for years. It carries the heaviest public debt load of any major advanced economy, more than twice the size of its yearly output. To stop that debt from crushing the budget, Japan kept interest rates extremely low for a very long time. Those low rates gave birth to one of the most important trades in global markets, the yen carry trade. In simple terms, you borrow in yen at close to zero interest, swap those yen into dollars, and then buy higher yielding United States assets, government bonds, corporate debt, even shares. As long as Japanese rates stay near zero and the yen does not suddenly jump in value, you pocket the difference. With borrowed money, that can look like free income. This flow is one reason American markets have enjoyed such strong foreign demand. It has pushed hundreds of billions of dollars into United States assets over time. But the whole structure rests on one condition: Japan has to keep money very cheap. In 2025, that condition started to fail. Faced with a weak currency and rising import prices, the Bank of Japan began to lift rates, taking its main policy rate up to around 0.75%, the highest in about 30 years, and hinting that more increases could follow. For an ordinary saver in Tokyo, that change feels small. For a large fund running a carry trade, it feels like the ground moving. Picture spending a decade on the same routine: borrow cheap yen, buy United States bonds, earn the spread, sleep soundly. Then, over a few months, your funding costs rise and the yen stops drifting lower. Suddenly, you're not clipping a safe coupon, you are one sharp currency move away from a serious loss. As Japanese rates rise and the chance of a strong yen increases, the neat arithmetic behind borrowing in yen to buy dollar assets starts to break down. If the yen strengthens while you're still in the trade, you take a hit in two places. The United States assets you own can fall if global liquidity tightens, and the yen loans you must repay become more expensive when measured in dollars. It does not take a big jump in funding costs and a couple of violent currency swings to wipe out years of careful profit. Faced with that risk, large institutions do what they are trained to do. They cut back. They unwind positions. They sell some of their United States assets, pay down yen borrowing, and step away. At the same time, the Japanese state itself, with public debt around 230% of national income, faces higher interest bills and may have to raise cash by trimming its own foreign holdings, including holdings of United States government bonds. Put simply, one of the most important long-term foreign buyers and lenders in the dollar world is, for domestic reasons, beginning to edge back. That means less outside demand for new United States debt, less automatic support for the currency, and more strain on a system already dealing with large deficits and political gridlock. Now put that alongside everything else we have seen. China is using its reserves to lock up physical resources. Japan is slowly reversing a trade that once poured cheap funding into dollar markets and may sell down some of its bond pile. The dollar is in a weaker phase, while key raw materials are in a tighter one. These pressures do not just sit side by side, they push in the same direction. Each time China spends dollars on metals, that is another sale of the currency. Each time a carry trade is closed or a foreign holder reduces its stack of United States bonds, that is one more step away from the old habit of recycling every surplus back into dollar assets. Meanwhile, Washington cannot simply sit on its hands. With the cost of servicing its own debt rising, and a growing recognition that it relies too heavily on overseas supply chains, it is under pressure to build its own buffers and domestic capacity for critical materials. That kind of rearmament is expensive. It calls for fresh spending, larger deficits, and more new bonds sent into markets that are already showing signs of fatigue. If outside buyers are less willing to absorb that flow, the easiest path is straightforward. Create more dollars at home and let inflation over time quietly reduce the true burden of what is owed. That is the soft default that modern systems tend to choose. It does not arrive as a single dramatic event. It creeps in over years, by paying creditors back in money that buys less and less, while people in states that own land, resources, and productive businesses see their position strengthen. In the current cycle, the country that is building the largest stock of real assets against this backdrop of dollar weakness is the same one that already holds the biggest pool of foreign reserves and sits near the center of key supply chains, China. Before we assume that Beijing has played this perfectly, it is worth asking one awkward question. What if they are wrong? There's a real chance that China is racing ahead of a future that does not quite show up the way they expect. Global demand for electric cars, solar panels, or data centers could fall short of the most optimistic forecasts if politics changes, technology moves in a new direction, or consumers pull back. Some of the mines they have bought into overseas could run into political trouble, tougher local rules, or simple bad management. They could end up paying rich prices for projects that never produce what was promised. If that happens, China still owns real assets, but the payoff is slower and the political pushback is stronger. Even in that less flattering version of the story, one thing still matters. In a world where key resources are hard to replace, the player that controls the narrow points in the system still has a lot of say over how the game is played. Whether that advantage shows up in 5 years or 15, the basic logic of grabbing control of the key junctions does not go away. So who actually comes out ahead in a world that is shifting this way, and who gets squeezed? On the winning side, you have countries with plenty of resources and workable governments, places such as Chile, Australia, Canada, and parts of Africa that manage to strike decent deals. You have states and companies that sign long-term supply contracts early, before shortages bite and prices climb sharply. You have borrowers in periods of higher inflation whose debts shrink in real terms even if the numbers on the page stay the same. On the losing side, you have savers in rich countries who hold bonds that pay 2 or 3% while their everyday costs rise faster. You have retirees whose pensions are full of long-dated government promises that only make sense if inflation stays low. You have countries that import most of their energy, metals, and food, and do not have much in the ground themselves, who find they must pay whatever the new gatekeepers decide to charge. You may not run a state or a large fund, but you still sit somewhere on that spectrum. So what does all of this actually mean for you? It means the rules that seemed safe for the last 50 years may not protect you in the next 50. For most of the post-war era, the default plan was simple. Save in the leading currency, hold high-quality government bonds, trust that inflation would stay tame and that, despite its flaws, the system would more or less preserve the value of your savings. Today, the signals are different. You open your banking app and see that the number is higher than last year. Then you walk into a supermarket and realize that number buys less. Imagine you're 30. You do not own a home, your pay has barely moved, but the things that could get you off the treadmill, property, productive businesses, scarce resources, seem to float further out of reach because bigger players are already positioning for a future you're only just hearing about. Imagine you are retired. Your pension statements arrive on time, but every one of those promises is written in a currency that is being quietly weakened to solve problems you never voted on. In the background, the balance of power is edging away from financial promises and toward control over real assets. The main reserve currency is going through a weaker phase at the same time that important materials are in short supply. Central banks, not just in China, have been adding to their gold holdings, trimming their exposure to the dollar, and building payment networks that let them move money without always passing through the traditional channels. If this direction continues, a few things follow. Keeping all of your wealth in paper claims in one currency quietly turns into one of the riskiest ways to feel safe. Assets that sit at the base of the system, energy, metals, infrastructure, start to look less like boring background and more like strategic ground. And the most valuable habit is not chasing the loudest headline, but learning to see how the system fits together. None of this means the dollar vanishes next year or that some dramatic crash on a particular date is guaranteed. Large systems almost never move in straight lines. There will be strong rallies, scary drops and stretches, where it feels as if nothing important is happening. Underneath those moves, though, the larger pattern is hard to ignore. Financial promises are getting shakier. Control over physical resources is becoming more important. Big players are adjusting to that reality, whether the average saver notices or not. You cannot decide what Beijing or Washington or Tokyo will do. You can decide how much faith you place in the old assumptions. You can start by asking yourself a few blunt questions. How much of what you own is simply a claim on someone else in a single currency? How much is linked to real activity, real cash flow, or scarce materials that people will still need whatever happens to the flag on the reserve currency? Do you know the difference between something that looks safe on a statement and something that is likely to survive stress in the real world? Nothing you have heard here is personal financial advice. Everyone's situation is different, and any serious decision deserves your own research and a conversation with qualified professionals. But understanding the direction of travel, the forces that are reshaping the landscape, is a first layer of protection. If you know that value is drifting away from pure paper promises toward control of things, you are less shocked when the buying power of your savings does not match the comforting number on the page. If this breakdown helped you see past the daily noise, share it with someone who is still thinking only in terms of yesterday's rules, and I genuinely want to hear how you see it. If you had to choose one store of trust for the next 20 years, a currency backed by promises, or a stockpile of materials the modern world cannot function without, which would you pick and why? Do you think China's push to lock down resources will really change who holds economic power? Can the dollar adapt and stay on top through this shift? Or are we already sliding into a permanently multipolar currency world? Tell me in the comments. I read as many as I can, and your perspective helps decide which parts of this story we dig into next. Whatever the next 5 to 10 years bring, remember this: currencies can appear almost instantly. Strategic resources take years to find, extract, refine, and bring under control. Right now, the world is slowly repricing that gap, and most people will only realize what changed and who moved first, long after the process is underway. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.